Hi, today I'm going to talk about how to keep your home. With all this COVID-19 going on and the sheltering in place orders in effect, it can feel like a really ominous time. Unemployment is at an all-time high and the number of unemployment claims skyrocketed to the highest figure ever reported. So some people may be worried about their ability to make their mortgage payments, or you might know someone that's worried about their ability to make their mortgage payments. Hi, my name is Tanja Odzak. I'm a realtor with Keller Williams and I work Oakland and the greater East Bay area. So I'm sure you've been hearing the word forbearance a lot everywhere, so I wanted to define that. So what is a forbearance? A forbearance is the inability to pay your mortgage payment and your loan provider agrees to reduce or possibly suspend your mortgage payments for a certain amount of time and agrees not to initiate a foreclosure during the forbearance period. So first and foremost, the most important thing is if you can continue to make your mortgage payments, then continue to do so. That would be the best thing. After that, if say you can't make your mortgage payments because say you lost your job or something, then you should call your mortgage provider right away or call the lender that you first work with to get the loan. And so during this time of COVID-19, Fannie Mae and Freddie Mac just released new sets of guidelines for any borrowers on single family mortgages. So a lot of folks will be eligible for forbearances if their loans are owned by one of these two, or if they're being held by certain major banks. But if your loan is held by someone else, say like an investor, then you very likely won't be eligible for a forbearance. So I'm going to include a link in the description below underneath this video where you can click on and look to find out who holds your loan. So at first it doesn't sound too bad, but what you should know is that this is a short-term solution. But because the consequences here are not without risk. You have to make sure that you really understand the terms, and they're likely to be different with different mortgage providers. So you have to be very careful because any of the missed payments have to be made up later on. They're not forgiven. It's not like you don't have to pay them. You have to pay them. So this is why if you can still make your payments on your mortgage, it's still the best option. So the reason is that while you are in forbearance, your loans continue to accrue interest. So that interest may capitalize, meaning that it gets added to your loan balance. So when you switch out of forbearance mode. So once you switch out of forbearance mode, you need to resume the full payment of everything that you missed at the end of the forbearance period. Plus, you have to pay an additional amount to get current on your missed payments, including your principal, the capitalized interest, the taxes, and the insurance. And the terms of the agreement, like I said, it will vary among different lenders and the situations. These extra large payment amounts, or having, you might have to do a lump sum, is what can be devastating to people because they can be so big. Having a forbearance shouldn't affect your credit score, but it can likely affect your ability to qualify for future loans and types of credit, and it can lead to getting charged much higher interest rates. But forbearance is still better than not making your payments and going into foreclosure. A better longer term and more permanent solution would be a loan modification. So this is where your lender can work with you to do a few things like maybe refinance or and reduce your interest rate, or maybe extend the length of your loan term. And what that would do is it would bring down your monthly payments. So the thing is, if you think that you are going to need a forbearance, then you probably should not refinance as part of a loan modification. Because the thing is, if you do refinance, then it's going to be much harder for you to get a forbearance on a newly funded loan, right? So when you refinance, then it's considered a newly funded loan. The other reason is if you miss any payments on your newly funded loan, then there's a risk of hundreds of thousands of dollars in penalties. So the bottom line is you really want to take a good hard look at your financial situation and see what you might need. And I mean, it's definitely very difficult during this time because there's a lot of uncertainty, but don't delay. The best thing to do is just to start doing your research early if you think that there may be an issue. So if you're interested in talking to me about how to keep your house and the options available to you, just call me. I really want to help, and keeping people in their houses is really important to me. And I'm sincerely happy to be a resource. As always, if you have any questions about real estate, I'm here for you. Feel free to contact me. Whether you want to discuss how to keep your house, your options over selling, or if you want to buy a house, I'm always here. I work Oakland and the greater East Bay Area, and it would be an honor to assist you, and especially to keep you in your home. Thank you for watching my video. If you find these helpful, please like my video below and subscribe to my channel.